Welcome to Cooking the Books. I'm Frances Cook, and this episode is brought to you by Mitre 10. A mortgage is one of the biggest financial commitments many of us will ever make, and it's expensive. A general rule of thumb is that by the time you pay it off, you've paid twice. One is the price of the house, and the other is all the fees and bank interest you pay through the mortgage. But what if you can cut that down? The way you structure a mortgage is really important because just changing a few settings can mean you're free years earlier. Here are the things you need to think about.
Newstalk ZB presents Cooking the Books with Frances Cook.
I'm joined now by Hannah McQueen from Enable Me. Now, when we talk about structuring your mortgage, what do we actually mean by that?
Well, it's the way that you position it to allow you to pay it off faster or not. So it involves a few things. It firstly involves your term. So how long are you committing to having that mortgage repaid? And for most people, it's 25 to 30 years. That's the default. So if you keep making your monthly repayments and if you never upgraded the home, just had that mortgage, you would be on track to pay it off within that term. So that's the first thing. Then the next layer of the structuring is, well, how do you structure it from an interest rate perspective? Of that loan size, do you put it all on one particular interest rate? Do you spread it over a few? Do you have some on floating or fixed? That's the technical piece of the structuring side. And how you structure it really depends on what your strategy is. So is your strategy to just minimize your repayments because you are trying to build financial resilience and that's what you've got to focus on, trying to stabilize your position? Or are you ready to actually drop the hammer on this and get rid of this mortgage as quickly as possible? There is a way to structure it from that side to protect you from yourself, but also to protect you from your biggest strategy, which is, well, what if your mortgage or your home actually is a stepping stone that allows you to grow wealth? If you want to be thinking about it from that angle, you would structure it a different way again.
Yeah. And this is the thing, right? I think people often take the default as the way a mortgage is paid. But like you say, you can have different goals with this, and you can even have more than one mortgage or more than one strand of mortgage being paid off at a time, right? How much of a difference can you make with different strategies depending on your goal?
Well, when I got my own mortgage initially, the difference from me structuring it correctly could save about between 5 to 10 years. But it actually saved me 20 years, but it had to be accompanied with a strategy to be better with my money, because it's premised on you having a cash surplus, which is money left over that you could put towards paying your mortgage off faster. And most Kiwis don't even get past that first hump. So even if they wanted to pay it off faster, there is no extra money to do that, because if you're paying it off faster, that suggests more money is going to the bank. So that money's got to come from somewhere. And unless you're prepared to compromise on your spending, it just might not be possible for some people. But what surprises them and what surprised me is that small changes can add up to a significant increase in your surplus. And statistically, we fritter 15% of our income. So that basically means that there's wastage or money that you spend that if you had a reason not to, you'd be happy not to, but you need a reason. If we can find that and put that into your mortgage and stretch you to be better from a behavior perspective, we can shave off more than 20 years off your mortgage. And that's when you would start to structure it more aggressively. But as an example, I had one client who was already on track to pay their mortgage off in 4 years. And I optimized that mortgage structure. So I used calculus to structure it kind of just perfectly. And it took 18 months off what they were on track to do, which is awesome. But that's what you're looking at from optimizing. It buys you an extra 1 to 3 years of mortgage reduction. The lion's share of it actually comes from having a surplus and making that surplus bigger. And that will take off 15 years of your mortgage. But if we can combine the two, then we can there is a precise way to structure it, but you have to be efficient to benefit from it.
And I think you're really right in terms of when you were saying that people need a reason. I think so much of money management starts with setting a goal. If it's something like getting rid of your mortgage and having that freedom years earlier and realizing that it is possible, you know, with small changes, then you are willing to make those changes. And I think people really do have to think about what sort of life they want and what sort of freedom they could attain, and then they're more willing to do these sorts of things. So let's do a bit of jargon busting, and then we're going to get into how you use all these things. If we're going into something like fixed or floating, and I know a lot of people love the Barefoot Investor, he has lots of followers and he is a huge advocate for floating, but what do these things mean? And how does it work in the New Zealand context? Because let's not forget, the Barefoot Investor is Australian.
Yeah, and how does it work in the New Zealand context, and how does it work in the current economic environment, right? So the difference between fixed and floating is the interest rate and whether that interest rate is varying from month to month. What a fixed interest rate does is it gives you certainty. You know, because you fix it for a period of time and you know exactly what your monthly repayments will be. So that is brilliant. The other thing about a fixed interest rate is it tends to be 1 to 1.5% cheaper than a floating rate. So the other way of looking at it is you've got to have a good reason to be on floating. Otherwise, you're just incurring a higher interest rate for the sake of it. And so then the question is, well, what is the reason? Well, a reason that you might have something on floating is if you are in a position to pay it off, a chunk of that mortgage faster. But because it comes at a higher interest rate, there is a point at which the cost will outweigh that benefit. And we need to understand that. And that's what that calculus formula that I use is applied to. So we patented that formula. It's to optimize, to determine at what point is the benefit going to be outweighed. And you would have no more on floating than you have a benefit of being on floating. Most people don't know how to calculate that, but I guess a hack, a kind of a crass way, is what's your cash surplus? So if it's $20,000 a year, well, that is the amount that you should have on a floating mortgage, because in theory, you would be able to channel that money into the mortgage and be able to pay off that floating rate. And if you are doing it systematically, the floating rate is getting calculated on the balance remaining. So as your balance drops, you get less interest charged. So if you are paying that down consistently, the interest cost will actually work out to be less than the fixed rate for that period of time. But it is premised on you having the cash surplus and in fact paying it off. And if you don't have the cash surplus, why would you have a mortgage on 1.5% higher interest rate? Even you just wouldn't. Like, it would just be nonsensical. But we would address the issue of we need to get a cash surplus so that you can unlock that. And then if I can just extend on that floating. So the floating is the description of the interest rate. What you really want with that floating is for it to be on a revolving credit. So that's an overdraft where it's on a floating interest rate, but as you pay off the mortgage, that floating portion, you can re-access it. So it gives you flexibility. So what people actually need is they need flexibility and certainty. So certainty to minimize their repayments and to know what they need to budget for. So that's a fixed interest rate. But where there is a surplus, and if we've maximized that, we can afford to be on a floating interest rate, but we want the flexibility of being able to re-access that money, because that really is your rainy day fund or your surplus. You are choosing to shoehorn it against the mortgage, which is great, but it is under the assumption that if you needed to, you could get that money back. Like in the current environment, I've had people that have chosen to make voluntary payments to the bank when things are going well, and then through the lockdown, they've lost their job. So they've gone back to the bank, and the bank have said, and I said, look, we need that money back. And it's at the bank's discretion if they give it back. Whereas if it was through a revolving credit, you would never need to ask the bank. That's your money to access, and you've literally just got internet access to that fund.
Okay, great. So to sum that up, basically a fixed is you've locked in that interest rate, usually for a year, 2 years, you can sometimes even get 5 years, and then you're locked in, you're paying that for whatever term you decided. Floating will move around with whatever the interest rate of the day is, and you can put extra on that. And of course, the idea is you would put in extra, but you're not forced to. You haven't agreed with the bank that you're going to every single week. And you would say that if you're attracted to the idea of having a cash, an area where you could put extra cash, maybe you do some contract work and you want to chuck it straight on the mortgage, that if you're interested in that, rather than going for floating, go for the revolving credit, because if things turn to custard, you can access it back. Is that a good sum up?
That's a good sum up. I will just say with the revolving credit, don't have FPOS access to it. So don't actually treat it the way the banks encourage you to treat it. That is dangerous, and that actually undermines that whole let's improve your behaviours around money concept that's going to create the cash surplus to allow you to have the revolving credit. But yes, if you have a revolving credit, that gives you flexibility to, in the case of a rainy day, to re-access it. But perhaps most importantly, if you are wanting to be ambitious and use that equity perhaps as a deposit for another property, that you can do that without having to plead your case to the bank.
Yes, absolutely. And I think that's a really good point, a little warning on the revolving credit, because you do have some people who say not to go for it if you don't trust yourself with having access to that sort of thing. You can, if you're someone who has difficulty with credit cards or spending on credit, that maybe it's not best for you, but you can make huge progress with it if you are someone who has discipline. So really good little reminder and warning for people there. Okay, while we're talking these sort of things, there's also the offset accounts, right? How do they differ amongst all this?
Well, the offset accounts is instead of having your money in a savings account earning interest, you have it in a savings account offset against a mortgage account of the same amount, and you don't pay interest on the mortgage and you don't receive interest on the savings. Mm-hmm. So they offset each other. And for some people, that could be a way that they retain flexibility. They like having that savings. And on occasion, it can work well. But more often than not, one of the reasons why people don't achieve their financial capability or unlock their potential is it's all convoluted. And I've got savings here, but it's offsetting that, because in theory, let me give you an example, that if you had $100,000 in savings, you would have $100,000 on a floating interest rate, and you're not going to pay interest on that. So that saves you, if we use a 3% interest rate, that is saving you $3,000 a year as a result of that. What people fail to do is to capture that $3,000 a year and to pay it off the mortgage faster. They just let that money slip through and get spent, and they think they're a little bit clever because they've got this offset thing going on, but actually that was supposed to unlock the next layer, which was supposed to allow them to actually pay off debt faster, not just offset things. And 90% of times they fail to actually execute on what's been made available to them. Mm-hmm. Mm-hmm. So it can work for some self-employed people. It can work if you've got big amounts in savings. It can work, but by jingoes, it's saving you interest in your mortgage. There is an amount that has saved you. You can just work out using math and save that difference. Don't just let it fritter through or kind of float through your spending and invariably get spent, which is where most Kiwis again fail.
Okay, great. All right. Well, I think we've busted some jargon there. And what I want to get into now is strategies, because like you mentioned, there are different strategies depending on your goal. So I think if someone's in a good position at the moment, if someone still has their job and they are wanting to get ahead financially, we've got a really split economy at the moment. So there are lots of people in that position. How can you start getting ahead and maybe cutting years off your mortgage with the least effort?
Well, you firstly need to engage with this. I think that the default for most people is they will take 25 to 30 years. So if we're going to change the dial on that, we've got to become purposeful with how we do it, because it just won't happen. The times of it just happening were about 50 years ago, where the size of the debt was still relatively low versus your income. So there was always sufficient surplus, which always allowed you just to pay it off. Provided you weren't bad, you were going to be okay. That was kind of how it worked. Whereas now, even if you're good with money, if you can't accompany that with a strategy and a plan and then execute on that, then you will get left behind. And what we're looking at the moment is this precipice of people who will be able to pull away from this noise and this uncertainty and really just drop the hammer on how quickly they can grow wealth. And that's where we tend to work with our clients. But you must first be in a stable position. And if you're not in a stable position, so that means that income is strong and you've got a degree of financial resilience. Resilience is the ability to survive a drop in income. So you've got maybe access to 3 or 6 months of savings or credit. It doesn't have to be savings, but you could ride out an immediate shock if needed. That's what we need to make sure you've got first. And if you don't have that, work on that. Now, if you are in a position where you've got strong income, you might not have a history of savings, which is the default. But if you've got strong income and if your income to debt ratio is in the following. So if your income was, let's say your household income 100,000, and if your mortgage was 400,000, so that's a 1-to-4 ratio, I would expect if you were working with us, and I'll explain not literally what working with us means, but what we do to get this outcome, we would expect to get you mortgage free in 8 years. But if your ratio is 1-to-5, we'd be aiming for maybe a 10 to 11 year mortgage repayment. And if it's 1-to-6, 7 or 8, we'd actually be thinking, should we be selling this property? Should we be throwing our current strategy out and coming at it from a completely different angle where, and this freaks most people out, where you say, actually, let's get you renting in a property that you're happy with, and let's use your equity that was on your home to buy 2 or 3 investment properties. And so over the next few years, I recognize you don't own your own home, but your money has the potential to work much harder for you, which over a 10-year period could be hundreds of thousands of dollars in difference in outcomes. But you said a really nice thing at the start, Frances. You said, well, because I'm a shopper as well, where you've just got to give us the reason. If we have the reason, then you can engage with it. It's just, can someone give you a good enough reason to try? And if the reason's strong enough, you don't resent the trying, provided you can see the progress getting made.
Yeah, exactly. And okay, so if someone, let's say they are doing okay on getting that cash surplus in and they have been budgeting, they've been working on these things, what are some of the ways, let's go with this best case scenario of the 1-to-4 and they want to get rid of their mortgage in 8 years, which I think most people would look at that and say that's stunningly fast. How can you structure your mortgage to help get you there?
Well, it comes down to, we've got to first maximize your cash surplus, and then we structure the mortgage in response to that. So whatever your surplus is, we'll try and double it, or at least make it true. And then we structure the mortgage. And we would recommend that the term of your mortgage is at its maximum. So still a 30-year mortgage, which lowers your repayment. So if you went from a 30-year mortgage to a 20-year, all that happens is you pay more to the bank in order to get mortgage free in a shorter period of time. So your fixed monthly repayments increase. Now we take the opposite view of that. We say, let's lower your fixed repayments to the bank. That will increase your cash surplus by whatever amount we've lowered them by. That surplus is going to go into a revolving credit. So it's still going into the mortgage, but it's through a funnel that isn't compulsory. So you could stop it if you needed to, but most importantly, you could re-access. And that's important from the strategic position of, if you were trying to position yourself to buy a new property or borrow more to buy a property, if your fixed repayments are too high, it counts against you with the bank. Weirdly, because you're kind of showing initiative by shortening your term, but it counts against you if you're wanting to access your equity to borrow again. So with our clients, we're trying to say, well, if I can maximize your cash surplus, because no one wants to cut back on costs, I understand that. Give me a reason to. Well, if I can do it enough, I can get you mortgage free in 10 years. And if I can unlock that, that means that in the next 8 months, we can position you to buy an investment property. and it's probably that motivates most people. That the fact that they're spending less or saving more doesn't excite a shopper, that's for sure. But if there is in pursuit of unlocking something else, and then if over 10 years that's $1 million difference in wealth, then that engages most people, right? And so you're prepared to have one less coffee a week. I'm not saying you go without your coffees, but you're prepared to do things you wouldn't normally even consider unless you can see why it's compelling. And then when you're supported with that and we get the results, there's this beautiful thing that happens, that you get that forward momentum and it gets easier. It's kind of like when you're losing weight, right? It just, as you see the results, you engage more, you become sharper and leaner, and that's when that snowball effect happens. And so for the first year we work with clients, we're trying to get the snowball to happen so that they can maintain it themselves after that if they decide.
Now a quick break for a word from our sponsor. If you're listening to Cooking the Books, then you're pretty interested in making smart money choices. Well, so is the team at Mitre10 with their new SmartMate Cash Account. A SmartMate Cash Account is a pay-as-you-go account for business, trade and commercial customers. It gives business access to trade pricing at participating Mitre10 stores across the country, or you can shop via their online trade hub. It's free and easy to apply online at mitre10.co.nz/trade/SmartMate. Find out more and choose the best option to suit your business. What if someone is in a slightly different position? And like you mentioned before, you need to be financially stable before you do any of this, because you need things like the emergency savings, you need to feel secure in your job, because all of that is your foundation. That very nice to pay off your house, but it will come crashing down if the foundations aren't set up. So if someone is struggling or is wondering if they might struggle soon, and they're looking at all of this chat around about things like the mortgage deferrals, which I think my personal point of view on the mortgage deferrals is that is an absolute last resort. It's better than going under, but that there are lots of other options before you get there. So what would you say to someone who's struggling at the moment, and maybe looking to reduce their mortgage payments, possibly stop entirely?
Okay, so if you're struggling from a financial perspective and you're wanting to know what to do with your mortgage, you've got a few options. You could break in this order. You would first look to extend your term, which should lower your repayments. Now, when you extend your term, that can trigger a break cost of your mortgage. So we need to make sure that the break will be offset by interest savings. So that would be the first thing you would do this, and in conjunction with that, in breaking your mortgage, you would fix onto a lower interest rate. Now, normally that just that offsets itself. So you wouldn't even be bothered doing it normally, because you pay a break cost, and then the break cost is calculated by, well, what are you able to fix on, and what interest will you save by fixing? And that kind of works out to be what the break cost is, kind of reversing it. So there doesn't tend to be much of a gain in breaking and refixing over time. It'll work out the same, unless your cash flow is the problem. And the benefit of that is you can break the mortgage and put that cost on the mortgage, and you get the cash flow benefit of the lower interest rate. So from a cost perspective, they work out about the same. But if you're in survival mode, that makes a huge difference. Like, that could literally halve your mortgage repayments, and it won't come at an overall cost, but it improves your cash flow immediately. So that's one thing that you would look to. The other thing, and this is, you could try and create a little bit of arbitrage. And so the break cost is calculated on, if you were to break your mortgage and you were to fix again today, they would work out about the same. But if you were to break your mortgage and not fix because you thought that the interest rate was going to go further down, then you might be able to actually create a cost saving. But you have to balance that with, well, if you break, you're on a floating interest rate, and the floating interest rate is higher than a fixed rate. So you've got to factor in that cost into that, that equation. But I'd be working on those things first, and then I'd be working on going to an interest only instead of fixed. And you can actually do interest only, and it doesn't break your mortgage. So maybe that's the first question that you ask: can you convert to interest only and not make principal repayments? Now, whether that creates a significant benefit to you actually is determined by the term of your mortgage. So when you are on a 30-year term, your monthly repayments, it's made up of principal and interest. When you're on a 30-year term, the principal portion is so tiny at that point. It's not really until you've got less than 15 years on your mortgage that it starts to grow. So going interest only, if you just took out a 30-year mortgage, it might save you a couple of $100 a month, but it's not going to save you as much as someone who's on a 15-year mortgage, where it might account for much more of the monthly repayment. But interest only first, then you would look to extend the term, which triggers a break. Then you'd work out, do I fix, or am I prepared to hold out a little bit longer to see if I can clock in a lower interest rate? Which lower interest rates are coming, absolutely. It's just when. And the cost of waiting, there is a cost for you. But we work through that. And then if that's not going to give you what you need, I would first look to cull all other expenses and adjust your lifestyle first before you go on a mortgage holiday. And maybe the one exception to that is if you don't have any cash resilience, anything that you can access, then taking a mortgage holiday and saving those mortgage payments would be helpful if you didn't expect to have stabilized your situation within a 6-month period.
I would also love, we're pretty much out of time, but I would love to touch on what you mentioned there, where you said lower interest rates are coming, because we have seen increasing predictions. I mean, pretty much all the major banks are now predicting they expect to see our official cash rate go negative next year. Now, these are, of course, predictions. This is not set in stone, but that would mean interest rates changing. It is debatable whether or not the average person would notice a difference. What do you think might happen if we saw a negative official cash rate from the point of view of an average person?
Right. Well, if you have savings, I don't know if that's an average person actually, well, then you're going to make nothing. And a negative interest rate actually means that you're paying the bank to keep your money. So that's a problem. And maybe the question, if you have a lot of money in savings and you're having to pay the bank to care for your money, you've got to question whether that's going to be the right thing for you. If interest rates truly go down low, that is the best time to leverage, and which is to get access to money to buy property or to start business. But property is something that the banks recognize or are prepared to lend against. They're not really prepared to lend against businesses. But those are the two areas where you leverage or you borrow to acquire an asset. And that leverage is, well, that's the difference of hundreds of thousands of dollars over the next 10 years if you do it properly.
Thank you very much for coming in and jargon busting and giving us some strategies. That was Hannah McQueen from Enable Me. Now, if you want to keep having money chats outside of the podcast, or maybe you have a question for the next one, then send them to me. You can find me Facebook, Frances Cook Journalist, Twitter, Frances Cook, Instagram, Frances Cook NZ. Pick your favorite, send me those questions. Let's get them answered. You can also subscribe to Cooking the Books pretty much everywhere, including iHeartRadio, Apple Podcasts, and Spotify, or just wherever you get your podcasts. And if this episode was helpful to you, then maybe send it to a friend so we can all learn more together. Until next time, have a great day.